Okay, for today's class session, we're going to be looking at mainly three different things in the non-current liabilities section that we're just going to be adding to that we've kind of already done some of these things. We're just going to be expanding like we've done in the previous chapters, like with the cash, we kind of expanded it to see petty cash and doing a bank rec. And then with the long-term assets, expanding those to see how you do mining or different depreciations. We're doing the same thing here. We're just moving down the line. So we finished the assets. Now we're going to be in the liabilities. Next chapter, we're going to move over into the owner's equity section. So the first thing I wanted to look at is payroll. How payroll is going to be a lot different compared to what we have been used to seeing so far. So far, when we've basically just been told that employees have earned a certain amount of money and then they're paid, and the entry would be very generic, something like this. And this would be okay if the person you were paying was a hired contractor. And there's a difference between an employee and an independent contractor. With an employee, you as the employer have to take out taxes. If they're a contractor, you don't take out taxes. You just pay them a flat fee, and then they are responsible for doing their own tax work, not you as the employer. But as most of you are at some point, or you are currently an employee somewhere, we're going to look at what you don't really know that goes on behind the scenes of your employer. So the first thing that I want to look at is I'm going to break this into two categories, and I've broken this down to just the federal type things that are taken out of your check, because there are a couple other ones down here that we'll talk about, but the three primary federal taxes that are taken out no matter where you live in the United States are going to be these three. And the first one is Social Security. So most of you have heard of that. You know that that's something that's taken out, but you probably don't have any idea how much. Social Security is taken out at 6.2%. Now in the book, they're gonna always give that to you. They don't expect you to memorize that. But if you go on into accounting, especially if you take our payroll class, Accounting 106, which is nothing but payroll, you will be expected to memorize this. And you'll be expected to memorize the next part, which is the cap. The book will also, in the problems, tell you the cap. Now, if you're still in the prior, if you're still in summer 2020, then this is the amount the book will give you. This is all the way back to 2017, the cap. The cap continually goes up every year just based on inflation. The percentage doesn't change. The percentage is kept the same. But the cap, as you can see from where 2017 is to 2020, that's a pretty big jump, just in those 3 years. For summer 2020, the book is going to have you use this as your cap, and I'll explain that. What that means is once your total wages for that year go above that cap, you no longer pay Social Security. So in a way, it's like a tax benefit for the rich, especially if you make over 100, in this case, 118,500. Now, it's a tax break, but then when you turn around and start collecting Social Security when you're old, then you only get to count this much as wages that you have made in that year. Even though you might have made $1 million, you can't start taking Social Security like you made $1 million and use that as your figure, as your wages. You have to stop it at the cap. So it kind of comes back, but just note with Social Security, once you hit a certain cap, you don't pay taxes, and we're going to see how that works in just a few minutes. Medicare, the book is going to give you this number as well, the 1.45%. The key with this one is there is no cap, so you're always going to pay at least 1.45%. These two together are what's known as Fica taxes. You'll probably have heard of that. Fica stands for Federal Insurance Contribution Act, and that's what is there for retirement purposes to help pay for, and this one is for your hospital stay if you have one when you are over 65, and then this is of course for your day-to-day living. It's kind of like a mandatory retirement plan for you. And then finally, your federal withholdings. The federal withholdings, the book is just going to give you the amount because it's more complicated to figure out what your actual federal withholdings are. It all depends on how much you make, and it depends on your marital status. So the book is just going to give it to you. When we get into payroll, if you get into the payroll class, we actually start figuring out there. Then down below that, the book may go into further items, and some problems they do and in some they don't. For Indiana, of course, we're going to have 2 other taxes taken out, one for state and then one for county. So both of those are going to be taken out of your check as well. And then what you've probably, if you've never done anything with payroll, whenever an employer hires you and then they pay you, they're always going to have, and you need to remember this, a minimum of 2 journal entries. Because they're going to have your journal entry where they pay you and then take out these taxes. And then they're going to have a separate journal entry where they have to pay their own taxes out of their own pocket. And you don't even know this is going on. When an employer pays you money, then they have to then pay to the Social Security the exact same and just match it as what you did. They have to pay into Social Security. Same with Medicare. They have to match whatever you paid in. And then with the last 2 down here, these are the unemployment taxes. So if you ever file for unemployment, the money just doesn't come out of nowhere. It comes from the employer ultimately, because the employer is feeding this unemployment system. FUTA stands for Federal Unemployment Tax Act. And notice it's very, very small. It's only 0.6%, or as a decimal, 0.006. And it's capped at 7,000. And then SUTA, well, that depends on state by state, because that stands for State Unemployment Tax Act. And the book, it's going to tell you the cap is 7,000. In Indiana, it's a little bit higher than that. It's 9,500. But we're always going to use what the book says, and it's going to say 7,000. And then they're going to give you the percentage, because the percentage differs per employer. If you don't lay off very many employees, then your percentage is going to be very, very low. You shouldn't have to pay into the system very much. But if your employees take out a lot of money because you are constantly laying people off, then you should be paying more in. So that's how that works. And the book is just going to give you a percentage. It's going to say 2.9%, for example. And then you're going to do the journal entry. So let's get into an example. There are other things that, of course, taken out of your check. If you have medical insurance premiums, that's coming out of your check. If you have 401k that you put money aside into your retirement account, that's coming out. If you have court-ordered garnishments, say like you're behind in child support, that's going to come out of your paycheck. Other examples would be like flexible spending, money you pay for that goes into medical, that you can pay for medical bills. But let's get into an example. I have this employee, and I tell us that their previous earnings, what their previous earnings are. And that's important for cap reasons, for Social Security and or FUTA and SUTA. Now, if this employee's only made $6,700, they're nowhere near the Social Security cap of $118,000. They're a long way away from that. But we're very, very close to the FUTA and SUTA wages. And we're gonna update a few of the numbers here in this example as I go through. Because my FUTA and SUTA are going to be a little bit different, and I'm going to take these. I'm going to go ahead and take these out as well. We'll just have the Fed rate, the SUTA rate. Now, let's put in here, because the book is going to give this to you, so I might as well too. 6.2% Social Security, and let's use the cap of 118.5, even though that's not going to come into play. The book will also tell you 1.45% for Medicare. When you open your sheet, of course, it'll already have this on there. I'll upload this most current copy. I just forgot to update it from what I use in my classroom. I use more up-to-date numbers instead of the older numbers, and I also use some state numbers. Let's get into this one and see how it works. So this employee earned $1,000. Just like my person up above, where we just did wage expense 1,000 and credited cash. Well, now it's a little bit more complicated than that. We have SUTA taxes at 4%, and let's say this is capped at 7,000, just like what the book will show. We'll have to remember that there are FUTA taxes. So FUTA is 0.6%, and that's also capped at 7,000. The Fed, I tell you 5%, so we'll just take 5% of the 1,000. And then Social Security, and then Medicare. All right, so how we start this one out? We started out exactly the same as what we did above with our really easy example. Wage expense 1,000, that's what the employee made, that's what I'm having to pay out. Now, the difference is I'm not paying the employee exactly 1,000 because I'm gonna break that 1,000 down into different categories and then show, let's take this out of here, and then show where those amounts are going. So out of the 1,000, the first 6.2% goes to Social Security. So if you take 1,000 times 6.2%, it's $62. Medicare, if you times 1,000 by the 1.45%, that's what you're going to get for $14.50. 5%, I tell us for the Fed, or $50, goes into the federal withholdings payable. These are all amounts that I'm going to have to pay to the IRS within probably the next month, within the next month generally. And then whatever's left after all the taxes are taken out, that's what I then write a check for to my employee. So on this one, I'm just going to get out the calculator and take 1,000. I know you can't see this, but take 1,000 minus 62, minus 14.5, and minus 50. That leaves $873.50 is what I would write a check for. Because you never, as long as you're an employee, you won't get a check for exactly how much you earned. Now, remember we said that there are 2 journal entries. This is just the first one. This is just showing your payment as the employee and then where the rest of your money is going to eventually go to these 3 departments. Now we come down to journal entry number 2. Journal entry number 2, let's stop it right here. We're going to have one debit, just like how we did above with wages expense, because we knew what that was. It was $1,000. We're going to have one debit here. It's just we don't know what it's going to be until we do all of the credits, until we take and figure up all of the different amounts that the employee has earned or that the employer owes. So remember, if we go back up to my little cheat sheet here, the 4 things that the employer has to pay in addition to what the employee pays. Social Security and Medicare are exactly the same. So I'm going to credit those, if you remember the 2 amounts. I'm going to put another $62 that I owe Social Security and another $14.50 that I owe Medicare. Then we go back up and let's look at our final 2 items, the FUTA and the SUTA taxes. And then SUTA, the key thing here is it's capped at $7,000. So once I hit that threshold, I no longer pay FUTA taxes for that employee. And we're going to pay taxes at this very low amount, 0.6%. Now remember the 7,000, because our person here has made $6,700. So once we know, if I take my old earnings, my previous earnings, plus my new stuff, if that amount goes over the cap, then you have to figure up what's left. And if you add these 2 up, it definitely goes over the cap. These 2 added together is $7,700. So what I have to do then is figure out how much do I have left to get to the cap from where I started out. So I started out at $6,700. The cap is $7,000. The difference between $6,700 and $7,000, there's $300 there. That's all the more that I'm going to pay tax on. So when I come down here and do my journal entry and figure out how much I owe FUTA, I only owe them 300 times 0.6%. So if you take 300 times 0.006, then you're gonna get this $1.80. And then I told us that the cap for SUTA is the same, $7,000, which for the book problems it will be. So we still only have $300 that I need to tax. And then if you go back up to the problem, it tells us that the SUTA rate is 4%. So I'm simply going to take 300 times 0.04, and that's $12. So I'm going to come down here and update this to $12. Now I've now calculated all 4 taxes. I can then enter in all what my X's are. And so I'm going to go ahead and add up the $12 plus the $1.80, $14.50 plus the 62 bucks. And my debit, when I'm ready to enter in this debit, it really will be, let's show where our X here is. Our X number here is $90.30. That would be our debit to this entry. That's how much in total taxes that I paid, in addition to what the employee paid. Okay, so the key thing you're going to want to remember are the caps, and then which taxes each person pays. Does the employer pay it? Does the employee pay it? Or do both of them pay it, like Social Security and Medicare? So we'll see some more examples of this when we get into the problems in our problem part of Connect. All right, so that's part 1. There's 3 parts that we're going to look at today. Part 2 is you shouldn't have too much trouble with this one, as long as you did all right a couple modules ago. I think it was maybe even only 1 or 2 modules when we talked about note receivables. Yeah, it's actually just last week's modules. When we talked about note receivables, we were earning money when we made a loan. Well, this time we're going to do it just the opposite. We're going to be asking for a loan, getting money, and then having to pay it back. Pay back not only the loan, the note, but also pay back interest. So what the book is mainly going to focus on is doing it just like we did in our 2 chapters ago. We're going to pay off a lump sum. But as we go along, we're going to make a year-end adjusting entry to show how much interest was earned at the end of the year, like usually at the end of December. And then finally, we're going to go through and show what the journal entry looks like to pay off the loan. All right, so here's my example. October 1, we received a loan from Bank One. It was an 8% loan, and it's due in 9 months, so due by the end of June. We're going to prepare the, oops, misspelled there. We're going to prepare the initial loan. Yeah, it froze up. Prepare the initial loan, the year-end adjustment, the adjusting entry to calculate interest, and then we're going to pay off the note. All right, so our initial journal entry to get the loan going is really simple. Just ask yourself, what are you getting? We're getting cash, $4,000. How are we getting it? Well, we're getting it on a note that we have to pay back. So our credit is a note payable for $4,000. Very simple. Now comes December 31, we need to make the year-end adjustment. And we're going to do that the exact same way that we figured our interest revenue before. We're going to use the PRT formula, principal times rate times time, and time is always in years. So we want to calculate how much interest has accrued from October 1 to the end of December. And in that case, we've got 3 full months, all of October, all of November, and all of December. So that's why the time here is 3/12. Simply just work backwards, put this in your calculator, 3/12 times 0.08 times 4,000, and you get $80. That's how much I owe at the end of the year. I don't have to pay it, but that's how much is accrued. So I'm going to show that we have interest expense of $80. and that I owe an additional 80 on top of the 4,000. Now comes June 30th, we're the end of the 9 months, and I need to pay back my loan. So when I pay it back, I'm going to not only get rid of the note payable, I'm going to pay back the 4,000. I'm going to pay back last year's interest that I owed, the 80 bucks. And then I'm going to pay back this year's interest from January 1 up through June 30th. I don't want to do the full 9 months because the first 3 are already calculated right here. I want to do the last 6 months. So I do 6 over 12, January through June, times 8% times 4,000. And I get $160. So when I make a check, I'm going to have to add up all of these, write a check then for $4,240. So that's what a loan looks like when you only make one final payment. However, that's not necessarily the most common method. The more common method is when you make, you get a loan and then you make monthly payments to start paying it down. Example, having a mortgage, having car payments, having student loan payments. Those are all very typical examples of making monthly payments instead of paying it all off at one time. And I wanted to show you just how it's a little bit different when you have monthly payments, because what's different is when you have monthly payments, this amount, the principal, is continually going down a little bit at a time. And the lower your principal get, that means the lower the interest is, and then the more money that, that you pay goes towards your actual principal and not towards interest, because you don't want it to go towards interest. So let's look at this example here. Let's say we bought a car for $15,000, and just to make it a little bit more realistic, I'm telling us we put $3,000 down right away. The rest of it I put on a 4-year loan at 9%. The monthly payments are 300 bucks. So this would be my first initial journal entry when I bought the car. What I get, I got the vehicle, my asset. I took out the 12,000 note. The rest of the 3,000 I put down as cash right away. So now when I come down to start making my first payment, come August 1 or the end of July, whatever it is, at the end of the first month, I need to do my interest calculation, but I'm only going to do it for 1 month because only 1 month has passed since I initially made my loan. So I'm going to take, I haven't made any payments yet, so my principal is still 12 grand. I owe, it's a 9% loan, and my time is only 1 out of 12, 1 out of 12 months. If you do that calculation, it comes out to be 90 bucks. And I'm going to skip through here and show you that first entry. This would be the first entry. I made a payment of $210 because, remember, let's go back up here. Remember the loan stated I'm making payments of 300 bucks. Well, I just calculated that of the 300, 90 is going to interest. So if 90 goes to interest, that means the rest, the $210, comes off the note, the principal note. So I don't owe 12,000 anymore. I owe 210 less than that because I'm making monthly payments and my principal is going down, down, down. And that's where you become and you start making an amortization table. So what I did here is I have these categories. How much am I paying? That's going to stay the same. How much of those payments go to interest? What's left? That's what goes to the note. And then what's the value of my note? How much do I still owe? So day one, when I took out the loan, I owe 12,000. Now, the first payment that I made at the end of July, made 300, and I calculated the 90. What was left? 210. If I take 210 away from the note, I only owe now 11,790. So when I come down here to August 31, and then I put in my 300 for payment, that doesn't change, but my interest expense will, because now this number is no longer 12,000. It's now only going to pay interest on 11,790. So when you stick 11,790 in the equation, you're going to come up with just a little bit less of interest. And then a little bit more goes to my note, which is good. And then I get a new value of my note. And then by the next month, my interest is going to go down just a little bit more. So my journal entry for August 30th is going to be similar, just with slightly different numbers. My interest expense is now only $88.43. I have a little bit more going to the note, but my cash is going to remain the same. I still make a check for $300. So that's the difference, and I think these are more realistic. And so we can continue this on, and it's best to do it in Excel. And we could do it for the whole 10 years or however long the loan is, 4 years. And our goal is, when I'm all done, this number should be 0, the book value. Now on this one, I don't think it's going to work out. I just made up these numbers. When you actually take out a real loan, they'll figure up this is what is going to matter. They're going to figure up your monthly payments based on getting this number to 0 with the current interest rate. So again, with my numbers, it's probably not going to work out. It's just made up numbers. Okay, so that's part 2. Our final part is looking at warranties. When you buy something large, usually a warranty comes with it, and then you can even tack on a more warranty if you would like. And then you got to think about, how do we account for that warranty from the accounting standpoint? Remember, you always, in accounting, you have to be conservative. Think back to just a couple weeks ago when we did, or just a week ago, when we did the account receivable, and then figuring out how much is going to be bad debt ahead of time instead of waiting until we actually write it off. We did that to be conservative, so that if somebody looks at my books, they can have a good idea of what's really coming in instead of just what I show as AR. They can take AR minus the allowance for doubtful accounts and kind of get a good net value. That's something similar to what's going on here. If there's a warranty involved, there's a good chance that on some of the products, I'm going to have to spend, as the seller, I'm going to have to spend extra money to make the product right because something's broke. And instead of waiting until that happens, in accounting, I'm going to estimate that it's going to happen. And then when it does, I've already shown it on my books as I know that that was going to happen, or I estimated it, and then I'm going to take away part of that liability that I've estimated when I do pay it off. So basically, you're expensing it ahead of time in the year of the sale, because you always want to keep your sales and your expenses together. You don't want to have your sale and then an expense 2 years later due to a warranty on the 2 year ago sale, because you want to have the expenses and the sales together as much as possible. And that's what's happening here. So when we sell an item, at the time we sell it, if there's a warranty, I want to make a liability and expense out that how much I think I might have to pay to fix whatever machine it is. Now, not everybody's going to need fixed, so I'm going to have a pretty low amount. So let's say, just for example, if I have if I sold something for $2,000, I may only put in there that the warranty will be like $70. Well, if the thing really breaks, it's probably going to cost me more like $300. But I'm going to do 70 for every single person, and not every single person's is going to break down. So when that $300 is going to come away from person number 1, 2, 3, and 4 all together, because probably only one of them is going to break down, and I need to spend the $300. But all of those 70s then added up to almost $300, so they equal out. So that's what I'm going to do. I'm going to figure up, I'm going to say, okay, 5% of whatever the sale price is. That's about what I expect to come back that needing warranty repairs. So that's what I'm going to expense right when it happens. And then I'm going to say, okay, I have a potential liability that I'm going to have to pay for because I'm going to have to pay for that part, but I haven't paid it yet. Then when I actually do make the payment or I do replace the piece, then I'm going to take out the liability and tell how I did it. Did I pay cash? Did I just give them the money back? Did I actually repair it and take some stuff out of my inventory that actually cost me money? So that's what my journal entry is going to look like. Let's do an example to kind of put some numbers in these X's here. So I sold a heating unit for $5,500, and let's throw in the sales tax. Might as well. Let's do that. Has 5% sales tax, and what the unit cost me was $3,000. This is kind of going back to what we've done in the previous weeks with cost of goods sold. The sale includes a 2-year warranty. It's estimated that 6% of sales I'll need to do repairs on whatever 6% is. That's back on July 1, 2020. Now, the following year, sometime in April, but definitely within the 2 years, one of my customers calls back and they need a part replaced. It broke. The part cost me $234 to buy it and to repair their unit at no cost to them. So let's look at the journal entries. So the first journal entry is just the one that we're already used to, showing that I made a sale. So I sold it for $5,500 on 5% for sales tax. So that's what STP is, sales tax payable. So the customer owes me the $5,500 plus the sales tax. They pay me, it tells me here in the journal entry, cash. So I get the cash for us for $57.75. Now there's always 2 journal entries, just like with payroll. I got to show the sale, and then I got to show the cost to me, the merchandise leaving my store. So cost of goods sold, and I told us in the problem it was $3,000. Get rid of my inventory for $3,000. Now the new part, I need to go ahead and do the estimate of the warranty. So I need to take $5,500 times 6%. $5,500 times 6% is $330. That's how much I'm going to put as an expense to help offset that revenue, because I expect to have to pay back an average of $330. Now, not everybody's is going to be $330. One person's maybe $900, but then 2 other people aren't going to have anything. So on average, it's $330 per sale. So I take that off of this, put that as an expense, and then show I have an estimated liability hanging on out there that I'm going to have to pay off probably. Now, comes next year, the client calls me. Their repair cost, remember, was $234. So when I actually go and make the repair, well, I take that off of my estimated liability because I'm now paying off a big chunk of the $330 that I thought I would have to pay. And then instead of actually paying for it, I've already bought the inventory and I had it already in a stash. So I'm just simply going to credit my inventory pieces to show I no longer have that inventory, and sometime later I'm going to have to buy some more product to help replenish that inventory. All right, that's all the items we have for this chapter with the current liabilities. So now we're going to, with our next segment, we're going to go in and look at a couple of the Connect exercises.